Prepare and diversify with gold and silver with Monex Vice President Mike Maroney, along with managing partner of CPM Group and author of the Monex Precious Metals Market Outlook Report, Jeffrey Christian.
Good afternoon. My name is Mike Maroney, and I'm here today with the managing partner of the CPM Group, Jeffrey Christian. We are very fortunate here at Monex to have Jeffrey Christian doing a special monthly video series to help inform our customers of the current situation that exists in the precious metals market and where Jeffrey sees the metals potentially headed. Jeffrey, Happy New Year. Great to chat with you. I'm very excited about this because obviously you're probably one of the top experts in the world on precious metals, and we've had some really exciting action in the market. We've seen gold bounce off the 1240 area and track all the way up to 1360. Jeff, where do you see gold headed in the short term, and do you think that the current action in the U.S. dollar is the real driving force behind this move?
I think there's several factors behind the move right now. I think the weakness in the dollar is definitely one of them, but I think there's a bigger change in investor attitudes. You know, for a couple of years, investors have been worried about the Fed raising interest rates having a negative effect on gold prices, and I think that investors are backing away from that now. And I think they're looking at gold and other commodities, and they're saying that these things really represent good value at these levels, especially given when you compare them to, say, the stock market or the bond market. So I think that there's a broader rekindling of investor interest that we're seeing. There's also some seasonal factors. There's some gold buying in China in advance of the Lunar New Year in February. So I think there are a variety of factors that are kicking in, and in the gold market, as soon as people start buying, other people stop selling.
It's interesting because if you look at the commodity markets overall and you look at the CRB index, the amazing thing based on where the U.S. stock market currently sits in comparison to commodities, we're still right at or a little bit below the price levels that we saw in the 2009 bloodbath sell-off in commodities. So there's a lot of room for commodities to potentially head higher.
Yeah, it's gold and commodities, and gold's quite distinct from other commodities in that it's really a financial asset. But all of these things have relatively low prices and relatively low volatility, while the stock market is going from record to record with relatively low volatility. And one of the points we keep making is that at some point the volatility is going to move back toward historically more normal or typical levels. And when that happens, it's going to be bad for stocks and it's going to be good for gold and commodities.
It's interesting because a lot of people have a tendency to get excited, and typically here people have a tendency to buy the highs. We just rallied $110, $115 in gold. Where do you see gold potentially pulling back to, or do you see gold potentially pulling back in the near term?
Well, we thought that the price could get up around where it is now. We thought $13.50 in January. We were looking for it to pull back to $12.80, possibly as low as $12.50 in February and March, and then basically trade between, say, $12.50 and $13.50 in the second and third quarters before starting to head higher toward the end of this year.
It's interesting. There's a saying, I think, in the commodities, it's, the longer you base, potentially the higher you race. And we've been putting in a solid base for the last 3 or 4 years. And you believe then 2018, maybe 2019 is when we potentially get the breakout that a lot of people are looking for.
We're watching a range of economic and financial and political issues that could be positive for investor demand for gold. And we're not sure when they will come home to roost, but we do believe that they will come home to roost. It's just a matter of timing. And our best guess is, the fourth quarter of this year or into 2019, you'll start seeing these markets move smartly higher.
We were extraordinarily fortunate a couple of years ago to develop this relationship with you, Jeffrey. And a matter of fact, back in 2015, December, you called the bottom somewhat in the palladium market. You had felt that that was going to be the metal for the next couple of years. And holy cow, we got a lot more than a lot of people expected. What are you looking at as far as the PGMs are concerned?
Well, it's interesting. I mean, palladium looks really top heavy right now, but I think it has some room to go further simply because the conditions that have pushed the price higher are still in place. And those conditions are, tight, relatively tight supply, stronger fabrication demand in the auto industry, where palladium's used for auto catalysts and gasoline-powered vehicles, and increasingly in diesel-powered vehicles too. So you have strong fabrication demand, you have relatively tight supply, you have ongoing supply and production issues facing the South African industry, and then you have a lot of congestion in the New York Mercantile Exchange palladium contract, and that has provided the occasion for spikes higher. May of last year, August, September of last year, November, December of last year, and it'll probably do so again in February and March because that situation has not resolved itself. It's a supply situation on the NYMEX, and as long as that's in place, I think this price can go higher. At some point, we do think it'll come off $100 or so, but we're looking at palladium prices staying strong for years to come.